Street tech stocks have had a rough 2022, but can the sector turn it around in the new year? Well, joining us now, Rohit Kulkarni from MKM Partners. Rohit, can big cap tech turn it around next year?
It's going to be tough first few months, and thanks, Morgan, for having me. In the probably first half of 23, they're going to be sideways to stay under pressure. We think there are more downward revisions to estimates to come. I think as we see in the first half, if estimates are going to come down, interest rates go up, valuation of high growth tech stocks are going to be under pressure. If you have a point of view beyond, say, Memorial Day next year, then I think companies like Amazon and Uber are extremely compelling, in my opinion. Amazon is trading below its kind of COVID lows. Amazon is the only company that has had clear upward revision to estimates over the last couple of years. So I think that's the one we like if you think you have the visibility beyond first half of 23. But short answer to your question, yeah, it's going to be times under pressure over the next, call it 3 to 6 months at least.
Let's talk about another name you have a buy rating on, and that's Meta. It's down 65% this year. Why are you sticking with that call?
I think the growth versus profitability conundrum that Meta has had, while Apple and TikTok have been weighing on Meta over the last 12 to 18 months, I think if you just dissect those two debates, I feel the first debate about focusing on profitability versus growth, that debate is going to kind of tilt into Meta's favor as the first half of next year progresses. We feel they are getting the right kind of message from investors that cut costs, focus on near-term profitability while revenues remain under pressure. So I think they are taking the right steps. So the first half of next year is going to be focused on higher margins and better cash flows. That should help with the stock's valuation in the near term. And as we progress in the next kind of 6 to 12 months, I feel both big external factors, Apple and TikTok, we would see evidence of that kind of ebbing on the fundamentals, ebbing on the revenue constraints that the company has had. And then net, I feel kind of this is a bet on Mark Zuckerberg over the longer term. He's the youngest big billionaire CEO. He has a lot of runway ahead. And I feel kind of as we get into the medium term, beyond the 12 months, cyclical tailwinds and execution should start flowing through. So I'm not saying that this is the urgency to buy it right now, but as the year progresses, we see this unfold. Profitability first, Apple, TikTok start to ebb in the second half, and then execution follows. So we like it. Amazon is the more compelling idea here, but Meta is something that is a company that we would be behind as the year progresses.
Rohit, how much do you think tech valuations were buoyed by zero interest rates? And then now that they're not zero and they're not going to be zero, and they may never be zero again, or at least for the foreseeable future, and they're significantly higher than that, how much do you think valuations still need to reset to catch up to what is a new environment?
Again, a rule of thumb that we have had here is every 100 basis points of higher cost of capital is kind of 10 to 12% in reduction in valuation. That's simple math. That's simple Excel kind of geeky stuff that you would want to do. So if you have a point of view that we are about down 40% for 400 basis points, then that feels to be in ballpark as far as where the tech valuations have converged with the new era of the cost of capital. If interest rates are bound to increase, which we think, our macro economist feels that there could be more interest rate hikes coming down the pike over the next, call it 3 months or so. That means there is another 5 to 15% of tech stock valuation correction. On top of that, we think estimates need to come down. So that's one of the reasons why, while we like mega caps through the recession, through the valuation correction, there are these factors about interest rates affecting valuations and the multiples, plus secular headwinds. Cyclical headwinds affecting estimates. So there is more pain to have, in my opinion.
Where does it leave you with a stock like Alphabet, which now for the first time essentially ever in its history as a public company trades at a market multiple? People now all of a sudden wondering about the long-term competitive advantage with some AI applications and things like that.
In our mega cap pecking order of the buy list at current levels, I would rank order Alphabet as number 3 behind Amazon and Meta. The reason why we feel that is, again, stock has done well. It's above its COVID lows very clearly, and it has gained market share during 21 and 22 away from Facebook. And largely that's because of all the Apple changes. We see margin pressure and market share erosion over the next 12 to 24 months. So I think we are at a peak multiple for Google, at least for the near term. And that makes me wonder that, there should be some sideways movement, more so for Google than the other two.